Are you a landlord in the UK? Have you ever had a year where you've made a loss on your property only to find it did absolutely nothing to lower your tax bill? You are definitely not alone. It's a really frustrating and surprisingly common problem. In this guide, put together by the experts at Pro Tax Accountant, we're going to pull back the curtain on 3 hidden tax traps that catch so many landlords out. And more importantly, we'll show you how to navigate them.
So let's just paint a picture for a second. It's the end of the 2025/26 tax year. You're looking at your figures and you can see your expenses, maybe a big repair job, soaring mortgage interest, or just an empty period. They've completely wiped out your rental income. On paper, you've made a loss.
So, naturally you'd think, great, I can just offset that loss against my main income, maybe my salary, and get a nice little tax rebate from HMRC. I mean, it makes perfect sense, right? Well, here's the kicker. For a shocking number of landlords, that loss is completely invisible to the taxman. It does absolutely nothing to lower your tax bill. Let's get into why that is.
Okay, so the first and by far the most common reason your loss might just vanish is what we call the allowance trap. Now, the government offers some very tempting tax-free allowances for property income. They sound fantastic, but, and it's a big but, using them comes with a major catch that can end up costing you a lot more than you save.
So you've got 2 main options on the table. First up, there's the property allowance. This gives you £1,000 of tax-free rental income from any property. And if you own it with someone else, you each get that £1,000 allowance. Then you've got the much beefier rent-a-room scheme. This lets you earn up to £7,500 tax-free, but it has to be from a furnished room in your main home. And again, if you own the home jointly, that allowance is split right down the middle, so you get $3,750 each.
Right. Listen up, because this is the crucial bit. This is the rule that trips so many people up. If you choose to use either the £1,000 property allowance or the £7,500 rent-a-room allowance, you are officially giving up your right to deduct any of your actual expenses. It's an either-or deal. You take the simple tax-free allowance, or you tally up and deduct all your itemized costs. You cannot, under any circumstances, do both.
And here's the stark reality of that choice. The amount of loss you can officially declare to HMRC if you've used one of these allowances is 0. A big fat nothing. Even if you spent thousands of pounds more than you've brought in, for tax purposes, your loss simply doesn't exist. Let's see how this plays out in the real world.
Okay, let's take a look at a real-life example. Meet Sarah. She's in London, and she rents out her spare room for £8,000 during the tax year. She's savvy, so she opts into the rent-a-room scheme, making her first £7,500 completely tax-free. But here's the snag. During the year, her boiler gives up the ghost, and a new one costs her £1,500. Now, because she used the allowance, she cannot deduct that £1,500 cost. So she still has to pay tax on the £500 of income that's over the allowance, even though in reality, that big repair bill means her actual profit was only £6,500. That $1,500 expense, it's just gone. Lost for tax purposes.
So you see how easily those allowances can cut you out. Now let's move on to an even costlier mistake that a lot of landlords make. This one is all about getting your head around the difference between a simple repair and a long-term improvement. Because, believe me, HMRC sees them as 2 very, very different things.
The magic phrase here is capital expenditure. So what is it? Well, it's any money you spend that fundamentally improves or upgrades your property rather than just maintaining it. The easiest way to think about it is this. It's spending that adds long-term value, not a day-to-day running cost, like, say, fixing a leaky tap.
This table makes the difference crystal clear. Over on the left, you've got your allowable repairs. These are also called revenue expenses. We're talking about things like a lick of paint between tenants or fixing that broken boiler we just talked about. These are everyday costs, and yep, you can deduct them from your rental income. But over on the right, you've got capital expenses. Adding an extension, that's a clear improvement. Upgrading a perfectly decent kitchen to a top-of-the-range luxury one, that's an improvement, not a repair. Installing a security system where there wasn't one before, that's an upgrade. And the most important thing to know is you cannot deduct these capital costs from your rental income to create a loss.
But hold on, here's a really important pro tip for you. While that fancy new kitchen won't help your income tax bill right now, it is absolutely vital that you keep every single receipt. Why? Because these costs can be deducted from your gain when you eventually sell the property, and that could seriously reduce your capital gains tax bill down the line. So they're not really lost, they're just parked for later.
Okay, so we've covered allowances and we've covered capital costs. Stay with me because this next point is absolutely crucial, especially if you happen to rent to family or friends. We're calling this one the uncommercial let penalty, and it's all about what happens when your kindness gets in the way of good business sense.
Have you ever done this? I mean, maybe you've let your nephew stay in your flat while he's at uni, or you've helped out a friend who's between jobs by giving them a really good discount on the rent. It's a very common and, generous thing to do, but it has some pretty big tax implications that you really need to be aware of.
So, if you're renting out a property for less than the normal market rate, HMRC doesn't really see it as a proper business deal. They have a special classification for it, an uncommercial let. And the logic behind it is that, well, you're not really trying to make a profit, so the normal rules for business expenses just don't apply.
This chart shows exactly what that means in practice. Let's say you charge your family members £6,000 in rent for the year, but your actual expenses, things like mortgage interest, insurance, maybe some repairs, they add up to £9,000. Now, in the real world, you've clearly made a £3,000 loss. But for tax purposes, HMRC puts a cap on your allowable expenses, and that cap is the amount of income you received. So you can only claim $6,000 of expenses to cancel out the $6,000 of rent.
And here is the really painful bit. That extra £3,000 in expenses is just gone. Poof, vanished into thin air. You can't use it to create a loss to set against your other income, and you can't even carry it forward to use in a future year when you might be renting the property out commercially again. That loss is completely and permanently disallowed.
So, we've just walked through 3 major tax traps that can make your very real financial losses just disappear when it comes to your tax return. It's complicated stuff, and it is frighteningly easy to get wrong. So let's do a quick recap of how to navigate them.
All right, here are the 3 key takeaways you need to remember. First, the allowance trap. Always do the maths. If your actual expenses are higher than the allowance, it's almost always better to claim the costs instead. Second, the capital mistake. Really get to know the difference between a repair and an improvement, and remember to save those capital receipts for when you sell. And third, the uncommercial let. Just be aware that renting to family or friends at a discount means you can never create a tax-deductible loss.
Now, it is absolutely crucial that we say this. The information we've shared here is for general guidance only. It is not a substitute for professional financial advice. Tax rules are incredibly complex. They are always subject to change, so it's always best to consult an expert.
And that really leads us to this final thought from Pro Tax Accountant. Navigating UK property tax is complex. Don't guess, get it right. Honestly, making assumptions in this area of tax can be a very expensive mistake to make.
So, if any of this has raised questions about your own tax situation, or if you just want to make sure your property portfolio is as tax efficient as it can possibly be, the team at Pro Tax Accountant are ready to help. You can reach them easily on WhatsApp or by phone at 07985689912, or just drop them an email at info@protaxaccountant.co.uk.
I really hope this has helped clear up why some of those frustrating rental losses don't always lead to a tax reduction. The key question for you now is, have you checked which of these traps might apply to your own situation? If you found this useful, please do subscribe to the Pro Tax Accountant YouTube channel for more essential tax guides just like this one. Thanks for watching.